Welcome to the deep dive. Today, we're not just glancing at numbers. We're really digging deep. Think of it like financial archaeology.
That's a good way to put it.
We're exploring the 9-month 2025 results for Baskent doğalgazda tüm gayrimenkul yatırım ortaklığı, Baskent Doğal is GYO. This is all about giving you, the individual investor, some real clarity.
And clarity is absolutely crucial here, especially when you're looking at a Turkish company right now. We're dealing with financials prepared under TFRS TMS 29.
The inflation accounting standard.
Exactly. Every single number we discussed today, revenue, costs, profit, it's all been adjusted to reflect the real purchasing power of Turkish lira back in September 2025.
So we're comparing apples to apples, not just nominal figures distorted by inflation.
Precisely. Without that adjustment, looking back at 2024 versus 2025 would just be, well, noise, meaningless.
Okay, so that's our baseline, our mission today. Cut through all that complexity. We want to understand first, how solid is their main job distributing gas? It's regulated, should be stable, right?
You'd think so, but we'll see.
And second, how does this company, operating in this high inflation world, manage to pull off such, well, massive profitability? There's a structural story here.
There really is. It's a fascinating look at how this specific GYO structure, an infrastructure GYO, navigates macroeconomic volatility.
Before we jump into the weeds, maybe just a quick snapshot. Scale.
Good idea. They're big. The country's second largest natural gas distributor, serving over 2.1 million subscribers.
Whoa.
And in these first 9 months of 2025, they moved about 3.4 billion cubic meters of natural gas. That gives you a sense of the volume.
Okay, that definitely sets the stage. And hey, if you find this kind of detailed breakdown helpful, please do hit that like button, subscribe for more deep dives like this one, and maybe share it with others trying to make sense of these markets. It really helps us keep doing this.
Absolutely.
Right, let's lay the groundwork. Who is Baskent doğalgaz GYO? Where do they operate? What's their business? They're in Ankara, Shankaya, we know that. But the history seems important.
Oh, it is. You have to understand where it came from. This whole gas network in Ankara started way back in 1988. It was under the city municipality's EGO directorate.
EGO, okay.
And the reason, it wasn't profit back then. It was about cleaning up Ankara's air. Terrible pollution from coal heating, apparently. So it was a public necessity project initially.
Makes sense. And then came privatization.
That was the big shift. Turnlar Energy, part of the Turnlar Group, bought 100% of the shares in May 2013.
And the price tag was huge, wasn't it?
Staggering. $1.162 billion US. That number alone tells you how valuable the long-term right, the concession, to distribute gas in Ankara was considered.
$1 billion just for the rights. Okay. And then a few years later, 2016, they changed structure, became a GYO, a real estate investment trust. Why does a gas utility do that?
That's the core of their financial setup. It's not a typical GYO focused on shopping malls or offices. It's an Altiaba GYO, an infrastructure GYO.
Infrastructure GYO. Okay, what's different?
It's designed specifically to hold and operate infrastructure assets and services. In this case, the gas distribution network itself. The GYO structure lets them put that huge concession license, the right to operate onto their balance sheet, as a massive asset. We'll see that number later. It's enormous.
So the GYO structure helps them value and maybe leverage the license, but their day-to-day job is still just gas distribution, tightly regulated.
Exactly right. The Natural Gas Market Law, number 4646, and the EPDK, the Energy Market Regulatory Authority, they dictate everything. Baskent doğalgaz's job is strictly buying, selling, and delivering gas in Ankara. Nothing else.
No side businesses.
Nope. Forbidden. So operationally, they're a pure utility. Predictable, stable in theory. But financially, because of that GYO structure, the inflation accounting, it gets complicated.
Let's talk operations then. Okay, that's a huge market.
Massive. They cover the whole metro area. Central HQ plus 12 branch offices. And think about collecting money from 2.1 million customers.
Yeah, how do they manage that?
It's quite a system. They have 79 of their own Gasmatic payment kiosks. You can pay PTT post office branches. And they have agreements with 18 different banks. Adds up to around 306 places where people can pay or sort out their accounts.
That sounds efficient. You need that for cash flow with so many small transactions.
Critical for liquidity, yes.
And the customer base is growing too.
Steadily. Not explosively, but steady growth. They went from about 2,070,000 accounts at the end of 2024 to just over 2,111,000 by September 2025. That little bit of organic growth adds a nice base. It does. And their position, second largest in the country, is solid. But honestly, the most critical thing for their revenue isn't just size, It's the regulator, EPDK.
Right, the regulation. Let's unpack that. Revenue comes from system usage fees set by EPDK, so it's rate regulated?
Correct. They basically charge a fee for using their pipes. And here's the, well, genius part for them in this environment. Those fees get updated every month based on the Consumer Price Index 2 fee.
Ah, so it's inflation indexed automatically.
Pretty much. Their core distribution revenue is largely protected from inflation eating it away. That's a huge structural hedge.
Wait a second, though. If revenue is indexed monthly, why do the numbers later show their operating margins getting squeezed? Shouldn't costs also be indexed, keeping margins stable?
That's the million-dollar question, isn't it? It's tricky. Yes, revenue is indexed, but specific costs might rise faster than the general 2-fee index. Think about labor, or maybe imported components, or even just the timing lag in the tariff adjustments. It's not always a perfect match.
Okay, so it's not a perfect inflation shield on the cost side.
Exactly. And you also have the tiered pricing system for the usage fees.
Ah, yes. Different rates for different users.
Right. As of September 2025, it went from 2.75 TL per cubic meter for, say, a small apartment, down to just 0.08 TL for a massive industrial user. 5 tiers in total.
So the average price they get depends on the mix of customers.
Precisely. If, hypothetically, industrial use, the lowest price tier, grows much faster than residential use, their overall average collected fee per cubic meter could actually go down, even if the individual tier prices went up with inflation.
Yeah.
That puts pressure on the overall margin.
Got it. That's a key detail for understanding the profit numbers later. Okay, ownership. Capital is 700 million TL. Who's in charge?
It's clearly the Tornlar Group. Tornlar Energy holds 75% dominant position.
And the rest?
The other 25% is publicly traded on the Borsa Istanbul. It listed back in June 2021. But even within that public float, another related company, Tornlar Gouda, holds nearly 10% of the public shares. So maybe closer to 15–16% is truly widely held.
And Tornlar ensures control through special shares.
Yep. They hold specific A and B group shares, 1 million of each, that give them privileges to nominate board members. Keeps management aligned with the main shareholder.
Let's look at that board. 7 members. Torun family members are there, plus independents.
That's right. Mehmet Torun is chairman, Aziz Torun is vice chairman. Then you have Mahmut Karabük, Ismail Kazanç. And the 3 independents are Salal Altunkanak, Alhami Ujahin, and Professor Dursun Ali Alp.
Any comment on diversity? The report mentions gender.
Well, based purely on the names listed in the report, it appears there are no explicitly named female members on the board. That's something investors increasingly look at from a governance perspective these days, that lack of gender diversity.
Okay. What about the workforce size and how much the top execs are paid? Staffing seems stable.
Very stable. Average of 696 employees in the first 9 months of 2025, virtually unchanged from 695 in 2024. Typical for utility.
But the executive pay.
And that's interesting.
How so?
Short-term benefits for senior management actually decreased in real inflation-adjusted terms. It went from about 40 million TL in 9M 2024 down to 33 million TL in 9M 2025.
A real term cut in this environment. That's surprising, down almost 17%. Any idea why? Cost control.
It could be a couple of things. Maybe tight control on administrative expenses generally, trying to offset that margin pressure we talked about. Or maybe it signals that the focus for shareholder returns, especially for the main shareholder, is more on dividends, which we'll see were very large, rather than just high executive pay. Could be a governance signal.
Interesting angle. Lastly, before we hit the numbers, what about related parties? They use group companies for services, right?
Heavily. Artuk does infrastructure work. Sungurbi handles meter reading and calibration. Technoville runs the call center and software. These aren't small amounts. We're talking hundreds of millions of TL in transactions within the group. It's all disclosed, of course, stated as being at arm's length.
Standard practice for a group like this, but important to know. And they have an investment, too.
Yes, they bought shares in Akçes Enerji Yatırımları as part of managing their investment portfolio. Okay, let's dive into the income statement. This is where we find the big puzzle, the main story of this period. How does operational performance get weaker, yet the bottom line, the net profit, just explodes upwards?
Right, the central mystery. And just to remind everyone again, every number we mention now is inflation adjusted. TFRS 29, real purchasing power as of September 2025.
Absolutely critical. If we looked at the nominal figures, you'd see maybe 60–70% jumps in revenue, just pure inflation. The adjusted figures tell a real story.
So let's start at the top, zero. Sales revenue.
In real terms, revenue actually grew modestly. It went from 29.5 billion TL in the first 9 months of 2024 to 30.8 billion TL in the same period of 2025.
So about a 4.4% increase in real terms.
Yeah.
Sounds okay given the indexed tariffs and new customers.
It's decent growth for a regulated utility, yes.
Mhm.
And the breakdown is healthy, roughly 14 billion from residential, 12 billion from industrial and commercial customers. Stable mix.
Okay, stable revenue. But you
Yeah.
said there's a problem starting here.
Yes. Look at gross profit, a brute car.
Okay. Ooh, that dropped.
Yeah.
Quite a bit. From 2.17 billion TL down to 1.67 billion TL.
Exactly. Real revenue up 4.4%, but real gross profit down over 20%. That's a major squeak.
Why if revenue is indexed?
Because the cost of sales, Satish and Melietti, grew much faster than revenue. It jumped from 27.3 billion to 29.1 billion TL in real terms. Input costs are outpacing the tariff increases.
What kind of input costs are we talking about?
Well, two big ones stand out in the report. First, labor costs, Ashilik Giderleri, up from 438 million to 535 million TL adjusted. Even with the same number of staff, wage pressures in an inflationary economy bite hard.
Like labor costs up. What else?
The really big one is depreciation and amortization related to that massive concession license. Remember the GYO structure?
Intangible asset, right.
That line item, Imtiaza Mayan Duran Varlik it Tapelora, went from 1.74 billion up to 2.01 billion TL. That's a huge fixed cost hitting the cost of sales. When that grows faster than the revenue from tariffs, which only grew 4.4%, your gross margin shrinks. Simple as that.
And that flows right down the income statement. Core operating profit, Isas Valiet Cutter,
Takes a similar hit, down from 1.74 billion in 9M 2024 to 1.25 billion in 9M 2025. This number tells you the underlying truth about the core gas distribution business. Year over year, it became less profitable in real terms.
Okay. Core operations squeezed. Less profitable. So, how on earth did net profit Dunam net Kari do the opposite? It didn't just rise, it soared. From 1.91 billion TL to 2.97 billion TL.
Almost 3 billion TL.
And earnings per share jumped from 2.73 TL to 4.24 TL. This is the part investors need to understand. How does operating profit fall by $500 million, but net profit jumps by over $1 billion?
This is it, the aha moment, like you said. The operational weakness is just completely swamped by financial items, non-operational, specifically inflation-related stuff.
Okay, break it down. What bridges that gap? Investment income helped a bit.
It did. Income from investment activities, mostly interest earned on their cash deposits, went up from 1.41 billion to 1.66 billion TL. Nice, but that's only an extra 250 million. It doesn't explain the billion-plus jump in net profit.
So what's the main driver?
The single biggest item, the game changer, is the line called Parasol Kite Kazans, monetary gain or loss. This comes directly from applying that TFRS 29 inflation accounting standard to the company's net monetary position.
Monetary position, meaning cash, debt, receivables, payables.
And crucially, those index liabilities like the customer deposits. Now look at the swing. In 9M 2024, they booked a loss of 221 million TL on this line.
Okay, a monetary loss.
But in 9M 2025, they booked a massive gain of 940 million TL.
Wow. From a 221 million loss to a 940 million TL. That's a swing of over 1.1 billion TL right there.
That's the engine. That monetary gain single-handedly drove the net profit explosion.
Why such a huge gain? How does inflation create profit like that on the book?
It's because the company has what's called a significant net monetary liability position. They owe more monetary items that aren't indexed perfectly or are fixed than they hold in monetary assets. And the biggest driver of this is that huge customer deposit liability. We'll talk more about the Govanspedelli.
The security deposits from 2.1 million customers. Okay, simplify this. If you
Okay.
owe money and inflation is high.
The real value of the money you eventually have to pay back goes down. Think about it. They collected billions in cash deposits years ago. They hold that cash, invest it,
Right.
earning that 1.66 billion interest. They owe it back eventually, and yes, the liability amount is indexed to TUF, so it grows on paper.
Right.
But under TFRS 29 accounting, when you restate everything to the current period's purchasing power, September 2025, the real burden of those past liabilities shrinks dramatically relative to today's money. Because their net monetary position is negative, they owe more than they hold in cash receivables. This shrinking real value of liabilities translates directly into a monetary gain on the income statement.
So ironically, the high inflation environment, combined with their structure of holding massive customer deposits, creates a huge accounting gain that boosts profit.
That's the structural advantage they have right now. It's not just about distributing gas anymore. It's about how their balance sheet interacts with hyperinflation accounting. That 940 million TL gain completely papered over the 500 million TL drop in core operating profit.
So investors looking at that impressive 4.24 TL EPS need to understand where it came from. It's real profit, yes, but driven by financial structure and inflation accounting, not by improved operational efficiency in selling gas.
Precisely. It's a crucial distinction. Right, let's shift gears to the balance sheet and cash flow. And the first thing that jumps out, linked to that high profit and what they did with it, is a huge change in their cash position.
Yeah, let's look at that. Cash and cash equivalents, Nikit Vinikit Benzer Larry, it absolutely plummeted. End of 2024, they were sitting on a comfortable 5.47 billion TL.
Very comfortable.
By September 2025, down to 1.54 billion TL. That's nearly 4 billion TL. Gone. Where did it go?
The cash flow statement tells the story. And first, let's be clear. The core business is still generating cash very well.
Okay, so it wasn't poor operations draining the cash.
No, quite the opposite. Cash flow from operations, was strong. It actually improved from 1.82 billion TL generated in 9M 2024 to 2.42 billion TL in 9M 2025. So the underlying business is throwing off plenty of cash.
Good. So they chose to spend that cash plus some of the reserves? How?
Two main areas show big outflows. First, investment activities, Yaktarim Fayet Larry, a net outflow of 2.57 billion TL. They reported spending 4.21 billion in total on investments during the period, maintaining the network, upgrades, fulfilling their concession obligations, necessary spending.
Okay, investing in the infrastructure makes sense. What's the other big outflow?
Enhancing activities, Finansman Fayet Larry. A massive outflow here too. 2.42 billion TL, and the lion's share of that.
Dividends.
You got it. 1.73 billion Turkish lira paid out as dividends in July 2025. That decision, combined with the heavy investment spending, is why the cash balance dropped so sharply.
That is a huge dividend payment relative to their cash position. Why prioritize such a large payout that drains liquidity, especially when interest rates are so high? You'd think holding cash might be attractive.
It's a strategic choice that signals confidence. Confidence first in their ongoing ability to generate strong operating cash flow. They clearly believe the money will keep rolling in.
Okay, confidence in future cash generation.
And second, perhaps more importantly, it signals a very strong commitment to shareholder returns. Remember who owns 75%? The Torun Group. This large dividend is a direct return to the controlling shareholder. Management decided deploying that profit immediately was better than letting it sit earning interest.
Satisfying the owner. Got it. Now, the assets. We mentioned the intangible asset earlier. It dominates the balance sheet, right?
Absolute fundamental. That concession license, Mari Olmayan Duran Balaklar, is valued at a staggering 42.68 billion TL.
43 billion, just for the right to operate.
That's the value assigned to the long-term distribution monopoly in Ankara. It dwarfs everything else on the asset side and really defines them as an infrastructure GYO.
Okay, let's talk debt. Borsulik. Given the cash drop, their net position must have changed.
Dramatically. They went from having more cash than debt, a net cash position of minus 2.5 billion TL at year-end 2024.
Meaning cash exceeded debt by 2.5 billion. Nice place to be.
But having more debt than cash. A net debt position of 1.3 billion TL by September 2025. Total financial borrowings stayed pretty stable, around 2.5 billion TL. It was the cash going down that flipped them from net cash to net debt.
And they're paying a lot for that debt, aren't they? The interest rate.
It's eye-watering. The weighted average interest rate on their Turkish lira loans is reported at 42.61%.
Ouch. Over 42%. That really underscores the cost of borrowing in Turkey right now. Carrying 2.5 billion in debt at that rate isn't cheap.
Makes that 1.66 billion in interest income they earned on their remaining cash even more important as an offset.
And there's security behind this debt, personal guarantees.
Yes, that's notable. The original privatization financing is secured partly by company shares, excluding the public ones. And key figures, Mehmet Torun and Aziz Torun, have provided personal guarantees muta sosyalen kefaleti for the credit lines. That gives lenders a lot of comfort.
But despite flipping to net debt, their overall leverage is still super low, isn't it?
Oh, incredibly low. Almost negligible for an infrastructure company. The report checks against the regulatory borrowing limit for GYOs. Their total debt is only 9% of their total assets. The limit is 500%.
9% versus a 500% limit. Okay, so financially, they are rock solid from a leverage perspective. Very safe.
Extremely robust structure. That low leverage is a huge positive.
And finally, equity is Kainak. That grew, right?
Yes, it increased from 25.62 billion TL at the end of 2024 to 27.1 Jul in TL by September 2025. That reflects the big net profit they earned, which easily covered the dividend payout and some other minor adjustments like actuarial losses. The equity base is strengthening.
Now, we need to come back to that weird liability item, the one that helps drive the monetary gain, the Guvenspedeli.
The guarantee fee, or customer security deposits, it's huge. 9.94 billion TL on the balance sheet.
Nearly 10 billion lira, owed back to customers eventually.
Right. It's a liability because they have to refund it if a subscriber cancels their contract. And crucially, the value of this liability is indexed to the CPI to 2.
So it grows with inflation on their books. But as we discussed, because it's a liability, the high inflation actually creates that monetary gain under TFRS 29 accounting.
Exactly. It acts like this giant interest-free funding source provided by customers. They get the cash, invest it, and while the liability grows with inflation, the accounting treatment in hyperinflation gives them that big bottom-line boost. It's much cheaper than borrowing 10 billion TL at 42% interest.
Okay, let's look at governance, management's outlook, and some key details from the footnotes, starting with that dividend policy that hit the cash reserve so hard.
Well, the decision was made at the General Assembly meeting in June 2025, looking back at the 2024 profits. They approved a total dividend distribution of 1.96 billion TL.
And the actual cash paid out in July was...
After accounting for some advance payments, the net cash that went out the door to shareholders in July 2025 was 1.505 billion TL. The policy is basically to distribute net profit after setting aside legal reserves and covering any past losses. It clearly prioritizes returning cash to owners.
Which, again, mainly benefits the controlling shareholder.
Okay. How did management feel about performance in these 9 months? Did they hit their targets?
They stated in the report that the 9-month 2025 budget targets were achieved. So, operationally, they seem satisfied, but they are very aware of the risks.
And the biggest risk is still the regulator, EPDK.
Without a doubt. Everything hinges on the tariffs EPDK sets, especially now. Remember, the special fixed tariff period they got during privatization ended back in May 2021.
Right. So what's the system now? How are tariffs set?
They're in what's called the third application period, running from 2022 to 2026. EPDK calculates the required revenue for the company. That's supposed to cover all their reasonable operating costs, plus give them a predetermined rate of return on their invested capital, their asset base. So EPDK decides what costs are reasonable and what the return should be.
Exactly. Any change in how EPDK calculates things, any cost that they don't allow, or if they decide on a lower rate of return than the company expects, that would hit the bottom line immediately and hard. It's a constant negotiation, influenced by politics and economics.
Which makes that margin squeeze we saw earlier, the falling gross profit, potentially worrying. If EPDK isn't letting them fully recover rising costs through the tariffs,
then that pressure will continue, or even worsen. It's a structural tension.
Yeah.
Management does manage operational risk, well, network security, repairs, and they hedge currency risk for investments. But that regulatory risk is just part of the business model.
And management's answer to risk seems to be confidence in cash flow.
They emphasize their strong cash generation potential as the key way they manage liquidity risk. Even though the cash balance is low right now, they expect the money to keep coming in.
Let's dig into one more cash flow item. We skipped over that big negative swing in working capital. What drove that?
Yes, that's quite revealing. Working capital changes caused a cash outflow of 1.94 billion TL. That's significant, and it wasn't due to receivables ballooning or anything negative like that.
So what was it?
It was mostly driven by paying down trade payables, specifically the amount they owed to BOTI, the state gas supplier.
They paid down their debt to BOTI. By how much?
Massively. The payable to BOTI dropped from 6.24 billion TL at the end of 2024 to just 1.23 billion TL by September 2025.
Whoa. They paid BOTI back 5 billion lira?
Roughly, yes.
Yeah.
They used the strong operating cash flow and the cash they collected from customers, traded receivables also decreased significantly, to clear a huge chunk of their short-term debt to their main supplier. It's a very conservative move, de-risking the balance sheet.
Okay, so that explains even more of the cash drop. It wasn't just dividends and infrastructure investment. It was also a strategic decision to pay down supplier debt quickly.
Exactly. Dividends, investment, BOTA shames, That's where the $4 billion in cash went. Shows active capital deployment, not just letting cash pile up.
Right. One last check, R&D spending. Any innovation focus?
Zero reported R&D for the period. That's not their game. They operate the infrastructure they have efficiently and reliably. That's the mandate.
But they do some social spending.
Yes, they reported just over 1 million TL in donations and social responsibility activities during the 9 months. Hashtag tag outro.
Okay, let's try and synthesize all of this. This deep dive into Baskent Dozolgaz GYO for the first 9 months of 2025 shows a really interesting picture. A company with sort of two personalities.
That's a good way to put it. The key takeaways. Operationally, it's stable, yes, but facing real pressure. Costs are rising faster than the regulated inflation-indexed revenue. So gross profit and core operating profit actually fell in real terms.
But financially,
Financially, it's a powerhouse right now. Net profit jumped 55%, driven almost entirely by that massive monetary gain. The accounting benefit derived from their large indexed customer deposit liability interacting with high inflation under TFRS 29.
the balance sheet is strong, huge equity base, incredibly low debt levels. But they chose to run down their large cash reserves through that big dividend payment and paying off BOTA. A shift from net cash to net debt, but from a position of strength.
And always remember the dependence on EPDK. Tariff setting is everything, especially now the old fixed rate deal is gone.
Which leads us to our final thought for you, the listener, to chew on. You've got a company here where currently the financial engineering benefiting from inflation via its liability structure is actually generating more profit growth than the core business of distributing gas.
So the question is, as an investor, do you prioritize this kind of company? One whose regulated structure provides this unique inflation hedge, turning liabilities into profit on paper? Or do you look for companies showing stronger operational growth, even if they don't have this specific structural benefit?
Is it better to invest in operational execution or in a structure perfectly suited to this specific high inflation environment? The numbers right now suggest the structure is winning, but you have to look past that shiny net profit number and understand why it's so high.
We hope this deep dive has given you the tools and the clarity to make that kind of assessment for yourself.
Absolutely. Thanks for joining us for this detailed look at Baskent Dozolgaz GYO. We'll catch you on the next deep dive.